The committee meets this morning to consider several bipartisan bills that are designed to promote a stronger, healthier economy and more jobs for the American people. I'm pleased to announce that several of these bills, combined with others the committee will soon consider in subsequent markup, will comprise the basis of a Jobs Act 2.0. Like its predecessor, the Bipartisan Jobs Act, passed by Congress and signed by the President last year, these proposals we will consider today recognize that small businesses are at the forefront of innovation and job creation, and that the growth and success of these smaller companies is essential if America is to experience a truly sustainable economic recovery that creates good-paying jobs with futures for the American people. And yet we know these very same small businesses that we are counting upon for entrepreneurship and job creation are simply suffering under the sheer weight, volume, complexity of Washington regulations that stand in the way of their growth and their success. Among the most significant obstacles that small companies face are regulatory barriers between them and our capital markets, a vital capital that they must have to open their businesses, keep them open, and to expand their jobs base. The Jobs Act has already reduced some of these barriers for emerging growth companies. For example, according to published reports, the online travel site Kayak, a discount retailer Five Below, and more than 40 different biotechnological companies were able to go public thanks to the Jobs Act. Perhaps most famously, Twitter was able to navigate some regulatory hurdles due to the Jobs Act so it could go public, hashtag more jobs for the American people. Why is this so important? Because as the National Venture Capital Association tells us, 92% of job growth of young companies occur after their IPOs, their initial public offerings. For the unemployed single mom, the laid-off factory worker, or the young college grad struggling to find her first job, job growth isn't just about numbers and statistics. It's about starting a new, a better, and a more secure life for themselves and their families. Truly, what could be more important? While these early successes of the Jobs Act are encouraging, Congress can and must do more during this period of little or no growth in our economy, continued high unemployment, and regrettable record-breaking red tape. As we have recently heard from witnesses who appeared before the Capital Markets Subcommittee, many of these regulations regarding capital formation were actually written for far, far larger companies. But as often the case in the nation's capital, Washington imposes a one-size-fits-all rules on the private sector. Thus, the burdens of these regulations that were written for many big businesses on Wall Street fall most heavily on small businesses on Main Street. As part of the Jobs Act 2.0 today, we will consider three bipartisan bills that will further reduce regulatory roadblocks impeding small business success and the creation of more jobs. H.R. 1800, offered by Mr. Grimm, will increase the availability of business development companies to lend to small businesses and help ensure the flow of capital to Main Street. I note that the gentlelady from New York, Ms. Velasquez, has championed this cause in the past and has a similar bill that she has introduced herself. H.R. 2274, sponsored by the gentleman from Michigan, Mr. Huizinga, and the gentleman from New York, Mr. Higgins, will streamline and simplify regulations so that small business owners can sell their small businesses when they retire, rather than perhaps be forced to close them up. H.R. 3448, sponsored by Mr. Duffy and Mr. Carney, will make small companies more attractive to investors and in turn produce higher rates of capital formation and jobs. Just as this committee recognizes that small businesses are the engine of job growth, we also recognize that community financial institutions that lend to them, both banks and credit unions, are essential to the success of small businesses. So today we will start by considering two bills that provide much-needed regulatory relief to our community banks and credit unions. I appreciate the opportunity to work with the ranking member on this matter. I know that she shares my concerns and the concerns of many on this committee that we are losing far too many of our community financial institutions in the unique role that they play in the economic growth of our nation. H.R. 3329, sponsored by Mr. Lukemeyer, as well as Mr. Murphy, Mr. Cotton, Mr. Quigley, Mr. Custer, other members, revised the Federal Reserve Small Bank Holding Company policy statement to help small banks and thrifts raise additional capital. H.R. 3468, sponsored by Mr. Royce and Mr. Perlmutter, provide credit unions parity with FDIC-insured institutions when it comes to deposit insurance coverage on certain trust accounts. These Regulatory Relief and Jobs Act 2.0 bills we consider today are a good faith bipartisan efforts to create a healthier economy. They represent precisely the kind of bipartisan action Congress should be taking to help our economy create more jobs. I once again thank the sponsors of these bills on both sides of the aisle. I look forward to our discussion today and look forward to future bipartisan efforts in the future to turn our economy around. I yield back the time I no longer have and recognize the ranking member for